Hello, this is Jessica Dunn, and I'm your professor for finance. This is Finance 330, and we will begin Chapter 1. Um, Chapter 1 is about the role of managerial finance. First of all, let's just define finance. Finance is both a science and an art. It is the science and art of managing money. Finance is not a hard science like chemistry or math, where there are fixed laws that state if you do X, Y, and Z, then this will take place. There are no hard promises in finance, so it is not a hard science. It is just as much an art as it is a science. The field of finance is going to answer several questions. It's going to answer who owns the company, who controls the company, who holds the risk, and who makes the profit. There are many different career opportunities within the field of finance. The first is financial services. Financial services are service-oriented jobs. They provide advice and they help design financial products for individuals. There are different career opportunities within the financial services realm. The first would be banking, a personal financial planner within the field of investments, real estate, and insurance. An opposite direction would be managerial finance. Financial managers are action-oriented. These individuals would develop financial plans, they would extend credit, or they would evaluate projects. Different certifications that a person in the field of finance could hold. The first is a Chartered Financial Analyst. The Chartered Financial Analyst, or CFA, is a graduate level course of study and is focused primarily on the investment side of finance. To become a CFA charter holder, there are 4 requirements that one must meet. First, a candidate must have 40 qualified work experience count.
Second, they must pass all 3 levels of the CFA exam in 6 hours. Third, a candidate must pay annual dues. A candidate must sign that he has followed CFA ethics. The second certification is a Certified Financial Planner, or CFP. The CFP is much less strenuous than the CFA license. It is a graduate course of work, and you only have to pass 1 exam, not 3. So the 1 exam, 10-hour-long exam, and it's related to personal financial planning. In fact, Murray State offers all of the courses necessary to sit for your CFA license. And here they are. In order for an individual to get their CFP license, they are required to take investments, employee benefits and retirement, income tax, insurance, and estate planning. So it's really nice if you take these courses while you're at Murray State, because you're already a full-time student, so they are technically free. If you wait until after you graduate and you want to take these courses, it's going to cost you thousands of dollars. So we're going to jump right in and start with different forms of business organization. The first form of business organization that we're going to cover is a sole proprietorship. A sole proprietorship is a business that is owned by one person and is operated for his or her own profit. There are several strengths and weaknesses associated with this type of ownership. The first strength is that it's simple. It's very simple to organize your business as a sole proprietorship. It takes very little time. You can log on to a website and complete all of the requirements in a very short period of time. The Kentucky Business One Stop
allows you to click through and fill out all of the paperwork necessary, and you would be in business. There's no need to hire a lawyer, no expensive fees. A second strength is that the owner has complete control of the company. So you're not having to consult with anyone else. You get to choose what you want to do, and there's no one to argue with. There are a few regulations for a sole proprietorship as opposed to a corporation. And finally, it's not subject to corporate taxes. There are weaknesses too. So the first weakness, the biggest weakness associated with a sole proprietorship is unlimited liability. This simply means that you are responsible for the debt that the business incurs. You and the business are essentially the same entity. So anything that the business does, you are responsible for. This is not true in a corporation. Another weakness is that it's hard to grow. Because the owners have unlimited liability, meaning that you're responsible for business decisions, it's very difficult to grow this. It's difficult to bring in other partners. It's difficult to meet with the bank and find financing. It's difficult to find friends and family to give you money. And then finally, a limited life. So a sole proprietorship is usually tied to one individual. It does have a limited life. If the owner were to die, you would at least have to file paperwork with the state to continue, and that's only if you have someone who is able to take their spot. So it may be a business and the children aren't interested, and now all of a sudden the parent dies, and now the business is no longer operational because the children have no interest in running the business. The second form of business organization is a partnership. This is a business that's owned by two or more people and operated for their profit. There are several types of businesses that are often organized as a partnership. The first would be an insurance company, a real estate office, a law office, or an accounting firm. Oftentimes, whenever you're watching TV, you may see a law firm talk about general partners and limited partners, and these are all characteristics of a partnership. Within a partnership, there will be at least one general partner. That general partner is responsible for the business decisions. There can be limited partners as well. The limited partners have the benefit of limited liability, so that they are not responsible for every single business decision. But there are strengths and weaknesses. First off, strengths. It has greater borrowing power than a sole proprietorship. So because there are more owners, there are more individuals' collateral to draw from, more people to sign the dotted line at the bank. And as opposed to a sole proprietorship, there is a greater distribution of work. So there are more owners, so there's more people to spread the work across. Now, weaknesses. In a regular partnership, there is unlimited liability. So for the general partners, they do have unlimited liability, just as a sole proprietorship does. Within a partnership, it is also oftentimes difficult to transfer ownership or to liquidate. So we'll just say difficult to sell. Perhaps one business partner wants out and the other business partner doesn't. Who do you sell to? Do you both have to agree on the purchaser? What if the remaining partner doesn't like them? There has to be some sort of agreement there. What if you can't find someone? What if you can't find someone to take over your position and you want to retire and your partner doesn't? What would you do in this instance? Perhaps maybe the partner could purchase your share of the business if they could afford it. Maybe they can take over and make the payments and pay you something. It would just be very, very difficult as opposed to a sole proprietorship or a corporation. And what about death? So what happens when a partner dies? So if a partner were to die, you're in the same situation again, just as it was whenever you were trying to sell. So now you own the company and your partner's heirs own the company. What if they don't know the business? What if they want to sell, but you can't afford to purchase their share? It just creates a whole conundrum of problems that could be eliminated through other forms of business organization. Finally, we're going to talk about a corporation. A corporation is a separate legal entity that is created by law. Corporations have legal powers similar to that of an individual. It can sue, it can be sued, it can make and be party to contracts, and it can acquire property in its own name. Ownership of a corporation is represented through shares of stock that can be freely bought and sold. So, strengths. First off, the most important strength is limited liability. So now, you as the owner of this corporation, you are no longer responsible for the financial decisions of the corporation. For example, if you own stock in Walmart and Walmart goes bankrupt, Walmart's suppliers are not going to come knocking on your door asking for their invoices to be paid. You have some protection. Another strength is that it is easy to grow. Because you have this fantastic benefit of limited liability, it's easy to find investors. People aren't scared to invest with a corporation. Additionally, it is easy to transfer ownership. Because shares of stock can be bought and sold easily, well, especially with a public corporation, it's very easy to transfer ownership. So let's continue with our same example. Let's say that you are still a stockholder of Walmart. So you are the owner of Walmart. You don't have to contact Walmart and say, well, I'm ready to sell my stock. Is that okay? Do we need to have a vote for that? You just simply log onto your E-Trade account and sell it. And finally, it has a perpetual life. Shareholders of Walmart die every day. They don't close the business. They continue operating. It's as if nothing ever happened. So you don't have to be concerned about what happens when an individual dies or a owner sells. Weaknesses. Corporations have higher taxes. The income earned by a corporation is first taxed at the corporate tax rate. Once it is paid to you, the investor, as a dividend, you have to pay taxes on that dividend again at your personal income tax rate. So the income that you're receiving is essentially taxed twice. It is legally complex. So it's not quite as easy as a sole proprietorship to click through and create a corporation. You will have to have some forethought into it. You have to have annual meetings and keep filings. It's just a lot more work to create a corporation than it is to create a sole proprietorship. There are greater regulations. This is particularly true for a publicly traded corporation. Publicly traded corporations are required by law to provide information to the government. And because they are required to provide this information, there is also a lack of secrecy. This is a fairly old picture, but it's still true today. In the United States, there are 17.6 million firms organized as a sole proprietorship. That is 73% of all firms. Only 20% of firms are organized as a corporation. But when we look at the receipts, those 73% of all firms are only bringing in 5% of receipts. So there are a lot of them, but they're not making a lot of money. Corporations, however, bring in 89% of all receipts. So there's a lot fewer of them, and they're making a whole lot more money. Why? Expanding successful companies want money from outsiders. Outsiders demand limited liability. So they want to be able to purchase stock and not risk their personal assets. And so for a company to grow and to grow substantially, they oftentimes have to be incorporated. This is how a corporation is organized. At the top are the shareholders. The shareholders own the company. They elect the board of directors. Each share of stock is eligible for a set number of votes. Those votes are used to choose the board of directors. The board of directors then hires the CEO. The CEO hires all of the executives, and the executives hire the managers, and the managers hire the employees. So it is a top-down structure. The board of directors is elected at the annual meeting. Existing managers send out a proxy statement to the shareholders to solicit their votes. Shareholders can be in different forms. There are 3 types of shareholders. There are just general shareholders. Then there are institutional shareholders. Institutional shareholders are companies that own shares of stock in other companies. And then finally there are block holders. Block holders are simply rich individuals, usually founding family members, who still retain a large portion of stock in a company. Board of directors can also have different characteristics. Board members are often elected for a 3-year term. If they are elected for a 3-year term, that means that only 1/3 of the board comes up for election each year. This is referred to as a classified board. The reason why companies oftentimes choose to have a classified board is because it helps prevent against a hostile takeover, because it would take 3 years for someone to come in and completely replace the entire board. The goal of a firm is to maximize shareholder wealth. So you as a manager should only take actions that are expected to increase share price. If it doesn't increase share price, you don't take that action. You must balance both risk and return. Our goal is not to maximize profit because profits are vague. Are we talking about long-run profits or short-term profits? And they may also be subject to manipulation. So, LIFO versus FIFO. What about the depreciable life of an asset? All of these things go into possibly manipulating the profits of a company. The rule of thumb is to maximize share price, which is to maximize shareholder wealth, because stock price is determined in financial markets. So there are lots and lots of people coming together to determine the share price. It is much less able to be manipulated than profits. And so we're going to further that discussion. Profit maximization is not the goal because, number one, timing. People prefer now to later. Second, cash flows. Just because your company makes a profit, that does not necessarily mean that there are cash flows available to shareholders. That money could be retained by the company. And finally, risk. Profit maximization fails to account for risk. So maybe it's a really bad idea with a small chance of payoff that actually pans out. You could make a lot of money, but you exposed your shareholders to a lot of risk. So here we are. We have 2 investments, the rotor and the valve. The rotor returns $1.40 in year 1, $1 in year 2, and 40 cents in year 3 for a collective return of $2.80. The valve returns 60 cents in year 1, $1 in year 2, and $1.40 in year 3. So it returns $3 overall. You may look at this and say, well, the valve makes more money than the rotor, so I prefer the valve. However, there are arguments that would cause you to perhaps choose the rotor. When we're looking at the timing of the cash flows, the rotor returns 50% of its return in the first year. You're not having to wait a long time for that. That doesn't necessarily mean it's the best investment, but it does give an argument as to why one may choose that. Later on in this chapter, with a little bit more information, you would be able to tell me exactly which investment you would prefer. Cash flows. So a yacht is sold for $100,000. That yacht originally cost $80,000. The company paid for the yacht this year, but at year end, they still had not collected the $100,000 from the customer, so they sold the yacht on credit. If we look at this from an accounting perspective, we see that we have revenue of $100,000. We have cost of goods sold of $80,000. So that means that we have profit of $20,000. So technically our company made $20,000. But when we look at this from a financial view, a cash flow view, we see that we had a cash inflow of $0. We have cash outflow of $80,000. So that means our net cash flow is a negative $80,000. So yes, technically we made money this year, but we don't have any money available to pay out to shareholders. We perhaps don't even have enough money to pay our electric bill. And finally, risk. Risk is the final reason why we don't use profit maximization as a rule for choosing investments. So we have a $50 investment. This investment has a 50% chance of being worthless in 1 month or a 50% chance of being worth $100 in 1 month. So you're going to double your money or lose it all. The expected return on this investment, just a side note, you don't have to know how to calculate expected return. Just follow along. This is something that we're going to do in Chapter 8, so it's not anything you have to know how to do right now. The expected return on this investment is 50% times $0 plus 50% times $100. So we expect to earn $50. Here we have a second alternative. We have a same $50 investment. It has a 50% probability of being worth $60 and a 50% probability of being worth $40. The expected return on this asset is also $50. So if we're just looking at the expected returns, they're both equal. It wouldn't matter which you chose. But once we look at the risk level, let's look at a really simplistic measure of risk. Let's just look at range. The difference between the maximum and minimum payouts. It says $100 range. Let's look at the range of the second option. This one has a $20 range. So the second option is substantially less risky than the first option. But whenever we're looking at just returns, they're the same. So we need to be compensated for the risk that we're bearing. Excuse the poll everywhere. We do this in lecture, but we're not in lecture right now, so we'll skip that. So yes, our goal is to maximize shareholder wealth, but what about our stakeholders? Our stakeholders are the employees, the customers, the suppliers, the creditors, and the owners who have a direct economic link to our firm. They are affected by our actions. So should we just abandon them in the cold and not care about what happens to them? Of course not. A firm with a stakeholder focus consciously tries to avoid actions that would be detrimental to their shareholders. Their goal is not to maximize shareholder well-being, but to preserve it. So we're not solely concerned about our stakeholder wealth. We're concerned about our shareholders' wealth, but we do want to not harm our stakeholders. If we're not harming our stakeholders, we're thought to be socially responsible. We're considering how our actions impact others. Business ethics. These are the standards of conduct or moral judgment that apply to persons engaged in commerce. There are lots of possible violations of ethics within the field of finance. Some of them are legal and some are illegal. Examples would be creative accounting, earnings management, misleading financial forecast, insider trading, fraud, excessive compensation, options backdating, bribery, or kickbacks. Not only are these unethical, but if these get out, then the negative publicity that they cause will also cause a negative impact to the firm's share price. So if you are not acting in an ethical manner, that could reduce share price, which is reducing shareholder value. So you would choose to not accept that course of action. Robert Cook, he is an ethicist, and he said that before you take any action, you should look to answer these questions. Does the action unfairly single out an individual or group? Does the action affect the morals, legal rights of any individual or group? Does the action conform to accepted moral standards? And are there alternative courses of action that are less likely to cause actual or potential harm? Ethics programs seek to reduce litigation and judgment costs, maintain a positive corporate image, build shareholder confidence, and gain the loyalty and respect of stakeholders. The expected result is to positively affect firm share price. So there are many companies that you may think of whenever you think of a firm with a stakeholder focus. For example, Google. Google's model is don't be evil. It's not enough to run a successful business, but they want to make the world a better place. Another example would be Starbucks. Starbucks' motto is to inspire and nurture the human spirit. They want everyone they touch to endure and thrive. So they're not cared just about their shareholders. They're also concerned about how the actions of their company affect others. Financial managers are responsible for the overall financial health of an organization. They are going to produce financial reports, direct investment activities, and develop strategies and plans for meeting long-term goals. So they are action-oriented. The managerial finance function depends upon the size of the firm. In small firms, this finance function is often performed by the accounting department. But as the firm grows, the financial section usually becomes its own separate portion of the company and would be directed by the CFO, the Chief Financial Officer. So how do financial managers make decisions? First off, they use marginal cost benefit analysis. They only take actions when the benefits exceed the cost. And so here is an example of marginal cost benefit analysis. So we want to purchase a new computer. The new computer is going to provide benefits of $10,000. So perhaps that means it would reduce accounting costs or improve efficiencies, but these benefits could be equated to $10,000. The old computer is only providing $3,000 worth of benefits, so by purchasing a new computer, we would have an additional $7,000 in benefits. The new computer costs $8,000, but we can sell the old one for $2,000. So the marginal costs here are $6,000. So because the marginal benefits of $7,000 exceed the marginal cost of $6,000, then we would choose to purchase a new computer. Financial and accounting activities often overlap. In small firms, accountants help carry out the finance function. And in large companies, the financial analysts often help compile accounting information. So they do work together. One major difference between finance and accounting is that accountants use the accrual method, while in finance, we focus on cash flows. We're not worried about whether a company is earning a profit or experiencing a loss. Of course, we want them to earn a profit, but they need to have sufficient cash flow to meet their obligations when they come due. So they need to be able to pay their electric bill and pay their payroll. A lot of companies go bankrupt because they are profitable, but they don't have enough cash flow to keep their business sustaining. And so here's that same example again. We have the yacht that we sold for $100,000 but hadn't collected at year end. And we paid $80,000 for that. So according to an accountant, we did really good. We made $20,000. But according to the financial manager, we have $80,000 negative in cash flows, meaning that we need some money to pay our electric bill and our payroll and all the other bills as they're coming to due. We also differ with respect to decision making. Accountants devote most of their time to the collection and presentation of financial data. Financial managers are making decisions on the basis of this data. So they're using the data that the accountants compile and they're making decisions based upon that. And we do that in our personal lives. In personal finance, we do not use accruals. We rely solely on cash flows to measure financial outcomes. So from this table here, we see that this person is spending more money than they're making. So they spent $215 more than they made this year, or this month, or whatever we're looking at, whatever period. So they need some other backups established. Perhaps they need a savings account from previous months. They need a line of credit. They're going to need a credit card. They have to have some way to make ends meet. The final topic within this chapter is corporate governance. Corporate governance are the rules and the processes and laws by which companies are operated, controlled, and regulated. It defines the responsibilities of the corporate participants, such as shareholders, board members, managers, stakeholders, as well as the rules and procedures for making complex corporate decisions. Corporate governance is influenced by both internal and external factors. Internal factors would be things such as the shareholders, the board members, the managers, etc. External factors, these are the customers, the suppliers, the competitors, the government regulations. So internal factors, we're talking about the shareholders here. There are three types of shareholders. Individual investors are those individuals that are investing small amounts of money. So they own relatively few shares as a percentage basis. And they're just investing to meet their own personal goals. Individual shareholders don't really have a lot of say-so in the company. They don't have the ability to call up the board members and say, I don't like what you're doing here. I would like for you to take a different course of action. There's no way that they could ever get through to anyone. Institutional investors, these are investment professionals such as banks, insurance companies, mutual funds, pension funds that are paid to manage large quantities of stock on behalf of others. So they have mega bucks to spend and they own huge portions of companies. These institutional investors do have the ability to enact change without selling their stock. So they do have the ability to call up the board members and say, we don't really like this course of action that you're taking, and if you don't sell, if you don't correct your actions, we are going to sell the stock that we own. No one wants that to happen. If they sell the stock that they own, That's going to increase supply in the market. An increase in supply causes a decrease in price. And then finally, there are block holders. Block holders are just rich individuals, usually founding family members, who own 5% or more of a company, and they do also have the ability to contact management. External factors. So government regulation. Government regulation shapes the corporate governance of all firms. Recently, SOX was enacted in 2002. This mandates financial disclosures with the intent of eliminating false financial disclosures and undisclosed conflicts of interest. So if you were to look at an annual statement, prior to the enaction of SOX, there was no section that stated persons of interest, related party transactions. The section that states all of the questionable activities that have happened at the company. There's also an agency issue within a corporation. Managers, who we call agents, are hired to work for the owners, who we call principals. This creates a separation of ownership and control. Agents do not always act in the best interest of the principals. So this principal-agent relationship is the relationship where the agent is acting on behalf of the principal. Remember, the principals are the shareholders. The shareholders don't have an active role in a corporation. The managers are taking actions that either benefit or harm the shareholders. And so agency problems arise whenever managers place personal goals ahead of the goals of shareholders. So they're no longer taking actions based on the decision whether or not this increases shareholder wealth. So why do agency problems exist? First off, personal wealth. So managers simply want to increase their personal wealth. They could be stealing, they could be paying themselves too much money. There are lots of ways that a manager could increase their personal wealth at a cost to shareholders. Next would be job security. So perhaps you're the manager of a company, and you as the manager know that if you take a specific course of action, then it would eliminate the need for your job. So instead of taking that action, you choose not to. So that way you don't have the problem of being out of a job. And finally, fringe benefits. Fringe benefits. So you are an executive of a company, and it's your job to decide whether or not to have the corporate retreat in Murray, Kentucky, or Honolulu, Hawaii. These choices affect shareholder wealth, but they also affect your fringe benefits. These problems arise when managers deviate from the goal of maximizing shareholder wealth, and they result in agency costs. So agency costs are the loss in shareholder wealth due to the agency problems. Examples of agency costs: failing to make appropriate investment decisions. So choosing not to accept a project because it may harm them personally. Another example would be fraudulent activity. A common approach to fixing these agency problems is to align pay with performance. So they structure management compensation to correspond to firm performance. There are a couple of options here for doing so. The first are incentive plans. Incentive plans are examples such as stock options. This would tie managerial pay to share price. Which is the best option? Incentive plans are much preferred over performance plans because incentive plans are tied to share price. And remember, we said share price is much more difficult to manipulate than other measures of profitability. Performance plans, they tie managerial compensation to measures such as earnings per share or the growth in earnings per share. These usually result in cash bonuses or even performance shares. But remember, we said that profitability is much more easily manipulated than stock price. So it's much better to pay stock options rather than cash bonuses. The highest paid CEOs are not necessarily the best performing CEOs. So here this is an efficiency rating by Forbes, and it's a few years old. But here we see that first, the best, most efficient CEO is the CEO of Priceline, and he is paid $7.49 million. He is 135th in the rankings. The highest paid CEO gets paid $141 million, and he is 90th in the efficiency rating. So just because you're paid more money does not mean that you're going to perform better. The structure of the pay is just as important as the amount of pay. You want to entice your managers to do the best work possible. And you can do that through pay for performance plans. Another thing that would keep corporate governance in line is the threat of takeover. So if a firm's internal corporate governance structure does not keep agency problems in check, it is possible that outsiders, managers of other firms, would look at this company and say, well, we could purchase it, fix all of these issues, and then resell at a profit. So they may try to get control of the firm. This can be a strong source of external corporate governance. So do you think CEOs are paid too much? You may say yes, but then what about professional ball players? Are they paid too much? Or do they have the special skills necessary to make a company run? It's an argument that has not been settled. And let me know if you have any questions. So this is the end of chapter 1. I'm available via text, phone, or email.